Welcome back to the Potaker Podcast, everyone. Your Tuesday morning edition covering major financial magazine headlines.
And welcome to the deep dive.
That's right. Today, we're not just going to, kind of scratch the surface. We're really going to dive deep into some of these headlines and really try to unpack what's going on. What are these signals telling us?
Yeah, absolutely. It's a fascinating time to be looking at the markets right now. A lot of different trends happening at once.
And we've got great source material today from, the big names, MarketWatch, Wall Street Journal, Bloomberg, and CNBC.
Yeah, a really great selection there. Should give us a lot to dig into.
Yeah, so let's kick things off with something I found pretty interesting from MarketWatch from March 24th. It's about Adobe, the software company.
Oh, yeah, I saw that one too. What was it? The CFO buying up a bunch of stock.
Exactly. Dan Dern, he spent over $500,000 of his own money on Adobe shares last week, 508,000 to be exact.
Wow, that's a pretty big vote of confidence, isn't it? You don't see that every day, especially from someone in his position.
And it's only the second time he's done this since becoming CFO, so it really makes you wonder, what does he see that maybe the rest of the market's missing?
Right. I mean, if someone who knows the company inside and out is willing to put down that kind of cash, you got to think they're pretty bullish on the future.
And MarketWatch even pointed out that the timing is interesting. This buy came right after Adobe's latest earnings report, which investors didn't really love the stock, actually hit a near two-year low.
So maybe he's seeing an opportunity there, like the market's overreacting and the stock is actually undervalued.
That's what I was thinking. And, it's not like Adobe's been having a great time lately. The stock's down 25% in the past 6 months.
Yeah, a lot of that is probably due to the whole generative AI thing, those concerns about how it could disrupt their creative software business.
Yeah, exactly.
Yeah.
So for the CFO to make a move like this, now it almost feels like he's saying, don't panic, we got this.
Yeah, I see what you mean. It's not just confidence. It's confidence in the face of a specific threat.
And MarketWatch also brought up Dern's previous stock purchase back in September of 2022. That was right around the time when there was all that uncertainty about Adobe potentially buying Figma.
Oh, right. And didn't that deal eventually fall apart?
Yep. But his timing back then turned out to be pretty good. The stock bounced back after those acquisition fears died down. So maybe he's got a knack for this,
Interesting track record for sure. Makes you wonder what he knows now that we don't.
It does, and it's not just him either. Apparently, an Adobe director named David Ricks has also been buying up shares recently, both after that whole Figma thing and then again in January this year.
Huh. So it's not just one guy at the top. There seems to be a broader sentiment among the leadership that the stock is a good buy.
Yeah, exactly. And, you got to ask themselves, are they seeing something that we're not? Are they successfully integrating AI? Do they have some new product line in the works, something that the market hasn't fully priced in yet?
Those are the million-dollar questions, aren't they? Obviously, we can't know for sure what they're thinking, but it definitely suggests a level of optimism about Adobe's future.
Right. And beyond just the insider buying, Adobe's also been ramping up its share buyback program.
Yeah.
In the most recent quarter, they bought back 7 million shares, which is a pretty big jump from the 4.6 million they bought back the quarter before.
Oh, wow. Yeah, that's significant. When a company buys back its own shares, it's usually a sign that they think the stock is a bargain.
Yeah, exactly. So it seems like Dern's putting his money where his mouth is, both personally and on behalf of the company.
And, share buybacks can have a positive impact on earnings per share, too, because there are fewer shares outstanding. So it's a move that could actually benefit all shareholders.
Interesting. All right, well, let's shift gears a bit and look at what's been happening in Asia. CNBC had a live blog running today, and it looks like markets there are having kind of a mixed reaction to President Trump's latest tariff threats.
Yeah, I was just looking at that. It's quite a range of responses, isn't it? Some markets seem to be taking it pretty hard, while others are more resilient.
Right. The Hong Kong market, for example, took a pretty big hit today. The Hang Seng Index fell by 2.35%, and the Hang Seng Tech Index, which is more focused on tech companies, dropped even further by 3.82%.
Ouch. Yeah, those tech companies are often seen as being particularly vulnerable to trade disruptions.
Makes sense. Meanwhile, mainland China's CSI 300 index actually closed flat today.
Huh. That's interesting. You'd think they'd be more affected than Hong Kong given the size of their economy and their trade relationship with the U.S.
Yeah, you would, but maybe they're just not as worried about these specific tariffs, or maybe they think they can weather the storm better.
Could be. And then you've got other markets like India's Nifty 50, which actually rose slightly, and Japan's Nikkei 225 and Topix Index both had modest gains.
Right. And South Korea's Kospi and the smaller Kosdaq Index both fell. And Australia's S&P SX 200 ended the day flat. So it's really all over the map, isn't it?
Yeah, it is. It's fascinating to see how differently these economies are reacting to the same global event. It really underscores how complex and interconnected the global financial system is.
Totally. And CNBC also had some interesting tidbits about specific companies in Hong Kong. BYD Co. Ltd. and Xiaomi Corp. both saw their shares fall pretty sharply today.
Oh, really? That's surprising about BYD. I thought they were doing pretty well. Didn't they just announce a huge jump in profits?
They did. Their net profit actually surpassed Tesla's total revenue for the entire fiscal year 2024.
Wow, that's impressive. So why the drop in their stock price?
It seems like investors might be more focused on the potential negative impact of the tariffs than on the company's strong underlying performance. Sometimes fear can really overshadow good news.
Yeah, that makes sense. And what about Xiaomi? What was their story?
Well, they recently did a pretty big share sale to raise money for their electric vehicle manufacturing plans, and that seems to have spooked some investors.
I guess they're worried about dilution, the value of their existing shares going down as more shares are issued.
Yeah. Right? Or maybe they're just not convinced that Xiaomi can really compete in the EV market.
Yeah, that's a tough business to break into, especially with Tesla already so dominant.
Speaking of tough businesses to break into,
Yeah.
let's talk about Japanese government bonds. The 5-year bond yield actually hit its highest level since 2008 today.
Wow, that's a big move. What's driving that?
Seems like it's mostly about expectations for the Bank of Japan's monetary policy. The minutes from their latest meeting show that board members have actually started talking about the possibility of raising interest rates.
Huh, that's interesting. I thought Japan was committed to keeping rates low for the foreseeable future.
Yeah, well, it seems like they might be starting to reconsider that stance.
Mm-hmm.
Maybe they're worried about inflation, or maybe they're feeling pressure to align their policy more closely with what other major central banks are doing.
Could be. Either way, it's a sign that things are starting to shift in Japan. And
Hmm.
then, of course, there's the whole situation with the Indonesian rupiah.
Right. CNBC mentioned that it fell to its lowest level against the US dollar since June 1998. That's a pretty big deal.
Yeah, currency moves like that can have a big impact on a country's economy. It can make imports more expensive, which can lead to inflation, and it can make it harder for companies to repay debts denominated in foreign currencies.
Right. So it's definitely something to keep an eye on.
So, bringing it all back to these tariff threats from President Trump, what specifically did he announce?
Well, the big one is a 25% tariff on any country buying oil or gas from Venezuela. It's supposed to go into effect on April 2nd, and it seems like China is the main target.
I see. Yeah, that's going to put a lot of pressure on those countries to find alternative sources of energy.
And it's already having an impact on oil prices.
Yeah.
Brent crude futures actually rose after the announcement.
Yeah, makes sense. It's basic supply and demand. Less supply means higher prices.
Well, let's move on from Asia for now and talk about something a little closer to home, specifically Social Security.
Oh, yeah, I saw a headline about that, something about some senators raising concerns about the nominee for Social Security Commissioner. Exactly. This was in Market Watch, too. Same date, March 24th. It's Elizabeth Warren and Ron Wyden, both Democrats. And they're worried about Frank Bisignano, the guy who's been nominated to head up the Social Security Administration.
What's the concern? Is he unqualified or something?
Well, he doesn't really have any government experience, which is kind of unusual for this position. He's the CEO of Fiserv, a big financial technology company.
So not exactly your typical government bureaucrat.
Nope. And what really has Warren Wyden worried is the possibility that he might try to privatize Social Security.
Oh, I see. That's a pretty controversial topic.
It is. And they're pointing to a few things that make them suspicious.
Mhm.
First, there have been all these recent changes at the Social Security Administration, things like cutting staff and closing offices.
And they think these changes are deliberate, like a way to make the agency seem less efficient and therefore more ripe for privatization.
Exactly. They're saying it's basically setting up the SSA for failure so that they can then come in and say, oh, look, the government can't handle this. We need a private sector solution. That's pretty cynical. But I can see how they might think that. And what about this Bisignano guy? Does he have any ties to the privatization movement?
Well, he's described himself as fundamentally a DOGE person, referring to Elon Musk's Department of Government Efficiency.
Right. Which has been pushing for all sorts of government reforms, including, streamlining and privatizing certain agencies.
Exactly. And Musk himself has been pretty critical of Social Security in the past. He's even called it a Ponzi scheme.
Oh, wow. Yeah, that's not exactly a ringing endorsement.
Nope. So Warren and Wyden are basically arguing that putting someone like Bisignano in charge of the SSA is like putting the fox in charge of the henhouse.
I get it. Yeah, if you're concerned about the future of Social Security, this is definitely something to keep an eye on.
For sure. And to make matters even worse, the senators also pointed out that there are now a bunch of people within the SSA who have backgrounds in private equity.
Oh, wow. So people who stand to benefit financially if Social Security were to be privatized.
Exactly.
Mm-hmm.
And then to top it all off, the acting administrator of the SSA has reportedly expressed concerns that DOGE's initiatives could, quote-unquote, break things.
Yikes. That doesn't sound good. It seems like there's a lot of turmoil and uncertainty surrounding Social Security right now.
Yeah, there is, and it's definitely something that could have a huge impact on the lives of millions of Americans. So we'll have to see how this all plays out.
All right, well, switching gears again, let's talk about something that's definitely shaken up the world of consumer tech. The 23andMe bankruptcy.
Oh, yeah, that was a big one. The Wall Street Journal had the story on March 24th. Apparently, they filed for bankruptcy late Sunday night, and their CEO, Anne Wojcicki, is stepping down.
Wow, I remember when 23andMe was like the hottest thing in Silicon Valley. They were valued at billions of dollars after they went public in 2021.
Yeah, and now they're practically worthless.
Yeah.
Their shares plummeted something like 50% after the bankruptcy announcement.
That's brutal. So what went wrong? They seem to have a pretty successful business model. You know, those at-home DNA testing kits were really popular.
They were. But it seems like they struggled to figure out what to do after that initial test.
Yeah.
You know, how to build a sustainable business around it.
Right. I remember they tried things like subscriptions and licensing their data to pharmaceutical companies, but it sounds like none of that really took off.
Yeah, and then Anne Wojcicki also tried to move into drug development. But that's a really expensive and time-consuming process. And with interest rates rising, it just became too difficult.
I see. So basically, they were a one-hit wonder. They had a great product, but they couldn't figure out how to turn it into a long-term success.
And it's not like they didn't try. Wojcicki even tried to take the company private at one point, but those efforts failed.
And didn't the whole board resign en masse at some point because they disagreed with her strategy?
They did. So it seems like there was a lot of internal turmoil as well.
This whole saga is a cautionary tale, isn't it? It shows how even a groundbreaking company with a seemingly great product can stumble if it doesn't have a solid plan for the future.
And there's also the whole issue of what happens to their massive database of genetic information now that they're bankrupt.
Oh, yeah, that's a big one. The Wall Street Journal mentioned that California's Attorney General has already issued an alert reminding people that they have the right to delete their data.
Right, because who knows who might end up owning that data once the bankruptcy proceedings are over.
It's a bit unsettling to think about, your genetic information being treated as just another asset in a corporate bankruptcy.
For sure. All right, well, let's move on to something a little less doom and gloom. How about some good old-fashioned economic anxiety?
Sounds fun. What have you got?
So the Wall Street Journal had a really interesting article on March 23rd about how investors are basically obsessed with economic data right now. They're poring over all these reports, trying to find any clue about where the economy is headed.
Yeah, I can imagine with all the uncertainty surrounding trade policy and inflation and everything else, it's no wonder people are nervous.
Right. And the article mentioned that they're not just looking at the usual stuff like jobs reports and inflation figures. They're even looking at what they called sleepy numbers, like bar and restaurant spending and jewelry sales.
Sleepy numbers, that's an interesting way to put it. So what are they hoping to learn from these less conventional data points?
I guess they're looking for any early sign of a slowdown in consumer spending. If people are cutting back on things like eating out or buying jewelry, it could be a sign that they're feeling less confident about the economy.
Makes sense. And it sounds like they're really digging deep into the data, looking at company earnings calls and even job postings on websites like.
Indeed.
Exactly.
Thanks.
Some analysts are even saying that this so-called B and C tier data can actually give you a better sense of what's happening in the economy than the more official government statistics.
Interesting. So they're basically trying to get ahead of the curve, spot any trends before they show up in the official data. Right. And the Wall Street Journal quoted one analyst who said that the market is, quote unquote, overreacting to almost every piece of data that's coming out.
Yeah, that's a sign of just how nervous everyone is right now.
Totally. And it's interesting because the article also mentioned that consumer sentiment surveys are showing a pretty negative outlook. But actual consumer spending hasn't really slowed down that much yet.
So people are saying they're worried about the economy, but they're still spending money?
Yeah.
Yeah.
It's a bit of a disconnect. And it just goes to show how difficult it is to predict what's going to happen in the economy.
Yeah.
Sometimes the data tells you one thing, but people's actual behavior tells you something else.
It's always a puzzle, isn't it?
Mm-hmm.
All right, well, speaking of puzzles, let's talk about the global shipping industry. Bloomberg had an article on March 25th about how the whole sanctions situation with Russia might be about to shake things up.
Oh, yeah, this one's fascinating. It's all about insurance. You know how ships are insured.
Right, right, because every ship needs insurance to operate.
Exactly. And there's this whole system of international insurers that provide coverage for most of the world's commercial ships.
And Russia has been largely cut off from that system because of the sanctions.
Right, which has led to the emergence of this so-called shadow fleet of older vessels that are operating outside of the traditional insurance framework.
And some of those ships aren't even insured at all, which is obviously a huge risk.
Yeah, and it's created all sorts of problems, concerns about safety, environmental damage if there's an accident, things like that.
Right. So what's Bloomberg saying about how this might change?
Well, they're saying that the global shipping industry might actually be open to working with these new insurers that are supporting Russia's shadow fleet.
Really? Even though those insurers aren't part of the established system?
Yeah, the idea is that if these new insurers meet international safety and technical standards, then they could become legitimate players in the market.
So basically the industry is willing to adapt to the new reality of the sanctions.
And the article even suggests that if the Trump administration ends up easing sanctions on Russia, these new insurers could become even more mainstream. They might even be able to join the main international group of insurers.
Wow. So it's a potential game changer for the shipping insurance industry.
And it shows how sanctions can have these really unintended consequences.
Yeah.
They can force industries to find creative ways to work around them.
Yeah, and sometimes those workarounds can end up becoming the new normal.
Speaking of new normals, let's talk about gold. Bloomberg had a couple of updates on March 24th and 25th about how gold prices are holding steady near their all-time highs.
Well, yeah, gold always seems to do well when there's a lot of uncertainty in the world.
Right, it's the classic safe haven asset.
Mm-hmm.
And what's interesting is that a lot of this recent strength seems to be driven by inflows into gold-backed ETFs.
Oh, right. Those are the exchange-traded funds that track the price of gold?
Yep, and apparently they had their biggest single-day inflow in over 3 years on Monday.
Wow, so investors really piling into gold right now.
They are, and the article says that gold has already rallied by 15% this year.
That's a pretty impressive gain. So what's behind this gold rush?
Well, as usual, it seems to be mostly about fear. Fear of trade wars, fear of inflation, fear of a global economic slowdown.
Makes sense. When people are scared, they tend to flock to assets that they perceive as safe, and gold has always had that reputation.
Right, and even though the U.S. dollar has been relatively strong lately, gold hasn't really been affected.
Yeah, gold and the dollar usually move in opposite directions, but it seems like the fear factor is outweighing that traditional relationship right now.
All right, well, let's move back to the tech world for a bit. MarketWatch had a report on March 24th about how semiconductor stocks actually rallied on Monday.
Really? That's surprising. I thought the chip industry was pretty worried about all the trade tensions.
They are. But this rally seems to be driven by hopes that the Trump administration might actually narrow the scope of their planned tariffs.
Oh, I see. So maybe the tariffs won't be as bad as everyone was fearing.
That's the hope anyway. And companies like AMD saw some pretty big gains in their stock price.
So it's a bit of a relief rally then. Everyone was bracing for the worst, and now it looks like it might not be so bad after all.
Yeah, exactly. But the article also pointed out that there's still a lot of uncertainties surrounding the existing restrictions on AI-related chip exports to China. Those AI diffusion rules that the Biden administration put in place.
Oh, right. Those are the rules that are supposed to prevent China from getting access to the most advanced AI technology.
Exactly. And the big question now is how the Trump administration will handle those rules.
Yeah, because those rules could have a big impact on companies like NVIDIA, which makes a lot of those high-end AI chips.
Right, and apparently there's even some concern that those rules could be extended to limit sales to U.S. allies as well.
Wow, that would be a huge deal. It would basically be saying that the U.S. is trying to control the global AI market.
And not everyone's happy about it. The article mentioned that Microsoft has been pretty vocal in its opposition to the AI diffusion rules.
Interesting. I wonder what their argument is.
Well, they're basically saying that the rules are too restrictive and that they'll actually harm U.S. interests by making it harder for American companies to compete globally.
That's a valid point. It's one thing to try to limit China's access to sensitive technology, but it's another thing to potentially stifle innovation and collaboration among U.S. allies.
Exactly. So it's a tricky situation for sure.
All right, well, let's head back to Europe for a minute. Bloomberg had a report on March 25th about Kingfisher, a big UK-based home improvement company.
Oh, yeah. What was it? Their shares took a tumble.
They did. They fell almost 13%, and it seems like the main culprit was their outlook for the year. Their predictions about future performance.
So they're not feeling very optimistic.
Not really. They're saying they're facing all sorts of rising costs, things like operating expenses, wage inflation, higher taxes, a new packaging levy. It's like everything's getting more expensive for them.
All of this despite the fact that they've actually been gaining market share in all their key regions.
So they're doing well in terms of sales, but they're worried about their profit margins being squeezed.
Exactly. And the article specifically mentioned that they're concerned about potential tax increases that are being discussed as part of the UK budget.
I see. So it's not just internal factors, it's external pressures too.
Right, and it seems like investors are taking these concerns seriously, hence the drop in the share price.
Yeah, it's a reminder that even a well-run company can be vulnerable to broader economic trends and government policies.
All right, well, back to oil one last time. Bloomberg had some further updates on March 24th and 25th about how prices have continued to rebound.
Yeah, I saw that. It seems like President Trump's tariff threat on countries that buy Venezuelan oil is really having an impact.
It is Brent crude is now trading above $73 a barrel, which is up more than 7% from its recent lows.
So that's a pretty significant jump. And it's not just the tariffs either, right? The article mentioned other factors that are supporting oil prices.
Yeah, they said that sanctions on Iran's oil exports are also playing a role, as well as signs of improving global economic growth.
Right, because when the economy is growing, demand for oil tends to increase.
Exactly. So it's a combination of factors that's pushing prices higher.
Okay, well, let's talk about something that's been on everyone's mind. The options market.
Ah, yes. The mysterious world of options trading. What insights can you offer us?
Well, Bloomberg had a really interesting article on March 23rd about how the options market seems to be focusing more on upcoming economic data releases than on President Trump's tariff announcements.
Really? So what are they watching specifically?
Well, the big ones are the core PCE price index, which is a measure of inflation, and the U.S. unemployment data, both of which are due out in the next couple of weeks.
And how do we know that the options market is focused on these data points?
Well, implied volatility, which is basically a measure of how much traders expect the market to move, is elevated for options contracts that expire around the release dates of these reports.
I see. So traders are basically betting that these data releases will have a big impact on the market.
Exactly. And analysts at Barclays pointed out that the market doesn't seem to be too worried about the impact of the tariffs, at least not based on how S&P 500 options are priced.
So they're more concerned about inflation and jobs than about trade wars.
It seems that way.
Yeah.
And the fact that the VIX, the fear index, has been relatively calm also suggests that investors aren't expecting a major market meltdown anytime soon.
Interesting. All right, well, let's wrap things up with one last stop in the world of geopolitics. Bloomberg had a report on March 25th about how Turkish bonds actually had a really good day.
Oh, yeah, I saw that. They were the best performers among emerging market peers.
And this was despite all the recent political turmoil in Turkey, with the arrest of that opposition leader.
Right. That was a pretty big deal. It made a lot of people nervous about the stability of the Turkish government.
Yeah, but it seems like investors are more focused on the economic outlook, and they're betting that the recent political events won't derail the government's economic plans.
So basically they're saying that politics is politics, but the economy will keep chugging along.
Yeah, and the government has been trying to reassure investors. President Erdogan came out and publicly endorsed the finance minister's economic program.
Right, and the central bank has also been intervening to support the Turkish lira.
So it seems like they're doing everything they can to maintain confidence.
And it seems to be working, at least for now.
Okay, so let's switch gears one last time and talk about the U.S. stock market. We actually have two contrasting viewpoints here, both from March 25th.
Oh, really? Bullish and bearish.
Exactly. On the bearish side, we have a strategist from UBS Investment Bank who's predicting an 8% drop in the S&P 500.
Wow, that's pretty pessimistic. What's his reasoning?
He's basically worried about the U.S. consumer. He says they're visibly tiring, and he's seeing warning signs in things like employment expectations, consumer spending outlook surveys, and consumer confidence levels.
So he thinks the economic engine is starting to sputter.
Yeah, and he's also concerned about the impact of the tariffs and Trump's trade policies in general.
Makes sense. Those things could definitely put a damper on economic growth.
But on the bullish side, we have Tom Lee from Fundstrat, who's actually predicting a big rally.
Oh, wow. That's a pretty different take on things.
Yeah.
So what's he basing his optimism on?
Well, he's pointing to those reports that the upcoming tariffs might not be as bad as everyone was expecting, with potential exemptions for certain countries.
Right. So maybe it'll be more bark than bite.
And he also thinks that Trump might be willing to back off on some of his more aggressive policies if the market starts to tank, what he calls the Trump put.
Interesting. So it's kind of like a safety net for the market.
And he also pointed to Tesla's recent surge as a potential sign that a broader market rally is already underway.
So he's seeing a lot of positive signals.
He is. So basically, we have two very different perspectives here. One cautious, one optimistic.
And the truth is probably somewhere in between.
Yeah, who knows what's going to happen, but it's definitely an interesting time to be watching the markets.
It always is. Well, we've covered a lot of ground today, haven't we? Everything from Adobe to Asia to Social Security to 23andMe to the global shipping industry to oil to options to Turkey.
It's been a whirlwind,
Mm-hmm.
but hopefully our listeners are feeling a little bit more informed about what's going on in the world of finance.
Yeah, and the key takeaway, I think, is that there's a lot of information out there, and it's not always easy to make sense of it.
Right. You have to be willing to look at things from different angles, consider different perspectives, and do your own research.
Exactly, and don't be afraid to ask questions. If something doesn't make sense or if you're not sure what it means, just ask.
Absolutely. Yeah. All right. Well, on that note, we'll wrap things up here.
Thanks for joining us, everyone.
We'll see you all tomorrow morning with new headlines from major financial magazines.